predicting what happens in one day or like in even 1 week is almost impossible. The hit rate goes really too close to random that you cannot discriminate. But if you trade fast, you can actually determine with decent accuracy. And we're still talking about 51% versus 49. I've never seen it with a hit rate more than 60%, unless you go to super high frequency. But in that case, the cost of trading becomes unbearable. So you can be 100% right, but you cannot monetize it because it's just so fast that either there is no liquidity or crossing the spread will kill you. So because of this, it's difficult to be right more than maybe 56% of the time.
Introducing bids to the Blockware Marketplace. Select from dozens of different ASIC models. The marketplace shows you the highest current bid, the lowest asking price, and the most recent sale price. Use this information to set a competitive bid. Once you're ready, input the amount of BTC or USD that you're willing to spend, the quantity of machines you want to purchase, and then hit bid. Once a seller accepts your bid, you'll receive an email notification. Click the link attached and send BTC to the prompted address. After 6 on-chain confirmations, the machine will be yours, and mining rewards will instantly be directed to your Bitcoin wallet. Get started today at marketplace.blockwaresolutions.com.
Hey everybody, welcome back to the Blockware Intelligence Podcast. This week I have on GP. GP, welcome.
Hey Joe, nice to be here. How are you?
Doing great. I know the audience may not know who you are, so let's get into your background. Like what's your academic background and what's your professional background?
Sure. Well, I have a PhD in electrical and computer engineering, and I was a postdoc at the University of Illinois at Urbana-Champaign back in the day. I graduated in 2004, and I worked, from the academic point of view in computer arithmetic and cryptography. That was my background. I wrote a bunch of papers, implemented a lot of interesting primitives, I would say like exposed. I think, with all the mining that and crypto, the work that I did, I think it kind of like, was more important than what I thought at the time. I think, I could have made a lot of money mining at the very beginning because I implemented all these, SHA-1, RSA, and AES in hardware. And so, they would have provided a nice boost for mining. I was just like, 10 years earlier. So, sometimes timing is everything. But after graduating, I moved to Silicon Valley and I work at NVIDIA and Intel. And then I started a company that was called ZeroSoft. We commercialized some technology that I developed together with my co-founder at the time. It was about accelerating simulation of transistor and RTL netlist. So absolutely unexciting. It was very difficult to find VC funding, even if it was around 2007. So there was some excitement, but finally we got VC and VC investment, and so we hired a bunch of people, mainly our people that we knew that were really good at coding, and built a product, got a couple of paying customers, and then we got acquired for a good amount of money, around $24 million in cash and equity by Synopsys, and life was good. The investors were happy. We made, the 4-5x return that they wanted to see. Everybody, got good chunk of money. Life was good. I mean, obviously, it was also incredibly stressful, and we had a couple of near-death experiences. We got acquired very close to the end of the runway. Literally, we had a few weeks of money in the bank when we got acquired. It was pretty crazy. But, everything is good. Everything was good. After that, I took a little bit of time off, and then I started working in finance. This was around 2010. And, I started applying machine learning to alternative data before alternative data actually had that name, and before machine learning was machine learning. In fact, I don't think we called it machine learning at the time. I think we called it like business intelligence or analytics. But anyways, a little bit too early. But the good thing is that we got we developed some interesting technology, and then I joined Tesa, which was a high frequency trading shop, one of the pioneer of high frequency trading in equities and futures. And I was head of data for 4 or 5 years. Built a lot of models, traded a lot of capital, and we had a good run. Life was pretty good. And then finally, I actually, while I was at Tesa, I met Paul, who's the co-founder of my latest startup, Kaizen, and we started moving around as a trading team. It's kind of like a mercenary lifestyle. You go to whoever gives you the best percentage of P&L, and we've done it a little bit. Work at the Engineers Gate, and then about quite recently we just quit and we started trading crypto. So kind of reapplying all the stuff that we've done in the last 10 plus years to trading futures and spot crypto. Besides that, I also teach machine learning and decentralized finance at the University of Maryland, and I also help with entrepreneurship. There is a pretty cool program at sponsored by NSF that commercializes technology from university, and I help there as a mentor and teaching. Again, I've been in the startup trenches for quite some time. So I've seen all sorts of crazy stuff, and so I think my experience can be useful for the youngster, so that they can try to avoid the many mistakes I've made so far.
Yeah, no, you have a pretty extensive background, so it's awesome to hear all about that. It's really cool. I guess so. Now that you trade, I guess like Bitcoin, crypto, where do you guys currently trade? And I guess how do you think about trading something like Bitcoin where it's super volatile? Like it goes through these crazy cycles. One day, massive bull cycle, massive bear cycle, and then even the day-to-day volatility can be pretty extreme. So how do you think about this compared to other assets that you may have traded in the past?
Well, I mean, definitely crypto makes life exciting. Volatility for the kind of models that we run is actually beneficial. We run relatively fast statistical arbitrage model. So, volatility is our friend in this case. We provide liquidity to the market and try to arbitrage away the inefficiency that is in the market. So we kind of, lubricate the market to make it work efficiently. We trade at kind of minute frequency, so it's definitely not high frequency trading where it's kind of like the millisecond or even nanosecond reaction time. I don't even know if it's actually possible for crypto in the current setup, because the system is so fragmented. There isn't really an obvious way of co-locating. So it's a little bit more of a level playing field. It's the model that wins. It's not just having like the fastest connection. I think in this sense, crypto is more democratic than equity and futures, because there everything is locked by a few huge companies that have like a technology advantage, and it's very difficult to displace them. It can be questioned if it's a good thing or a bad thing. I mean, the whole diatribe around high frequency trading, it's really difficult to unpack. I mean, obviously, I think there is a need for arbitrageurs to make the model, to make the system efficient. But I think I really don't. I might be controversial here, and I mean, I think when you have an advantage by trading a few nanoseconds ahead of somebody else, I really don't see what is the social benefit of this. It's just kind of rent extraction, and for whatever reason, some players have a little bit, an advantage in technology, and they can, milk the system. Obviously, the other side of this is that, they say, well, just put together $100 million and you can just like do what we do. So, there is a barrier of entry, but it's not a monopoly. It's not. They would probably say it's not an oligopoly, but in reality, it's kind of it's difficult to break into the system. I've seen that it's very difficult to compete with those people. And crypto is a breath of fresh air. There isn't that much regulation, which obviously has pros and cons. So I think it's an extremely interesting experiment of trying to rebuild the financial system from scratch, and without really, kind of a centralized supervision by the government. It's just like, let the market loose, see what happens. And so far, what has happened is like a lot of, crazy amount of volatility, but also tons of scams, lots of bubbles, and a lot of fear of missing out. It's kind of an interesting experiment in human civilization. But yeah, coming back to your point about the extreme volatility, there is no doubt. The question is, what can you do about it? Is it justified? I think, in my opinion, the fact that there isn't really an underlying instrument, for Bitcoin, is just like a bet on the future. I think everybody agrees that crypto is the future. It's a way of improving the shitty financial system that we have right now. By the way, can I use some bad words? Is that okay, Joe?
Yeah, that's fine.
I mean, I don't think anybody can call the current system that we have not shitty. I mean, it's when it takes 3 days to make a wire, or you need to pay 3% just to swipe a credit card. I don't think there is any doubt that the system is completely screwed. There are some entrenched interests, and those people that make tons of money have a way to lobby and make sure that nobody gets into their turf, and they can keep eating their pie. So I think in the medium term, I don't have any doubt that crypto will kind of reset completely the system, especially once you can start pay, you can do microtransaction with crypto. I really don't see why would anybody use a credit card or like $1. I mean, I think it makes no sense. Any interaction that I have with a bank is unsatisfying. Nothing works. Just look at the website. Just total absurdity. Because again, there is no competition, right? They can just sit down and milk the situation, and they know that nobody can easily break in because there is all this regulation, which I think it's totally justified. But at the same time, there is no innovation whatsoever. And so I think crypto it's a bet on the future. And the question is, what is the value of something that can be completely disruptive of the way we do things, right? And so one day somebody says, well, it's worth $30,000 per Bitcoin. Another day somebody says 35. So it's really driven by news, by fear, by news. It's really, there is no underlying value of that. And so it's just a bet on maybe on how long is it going to take before the system is reset, and you can use crypto for everything. And so because of that, every day the price is different, and there is all this crazy volatility.
Yeah. So I guess, how do you think about, with what you're building, like how do you think about capitalizing on Bitcoin's volatility? Like, how are you trading it? How are you, like, where are you trading it? What are your thoughts? Like, and how are you doing? Like, what are the variables that you're using to trade it?
Well,
like, why do you think it's going to go up one day, and why do you think it's going to go down one day?
Well, we actually look at things even more granularly. We look at what's going to happen in the next minute. If you look at the news and you look at market microstructure, it's those are like really the drivers, because you're measuring the inputs to the system at different points. Like, for instance, if you look at news and you say, well, this is good news for Bitcoin, assuming that you're good. You have a model that allows you to understand if something is good or bad for Bitcoin, which is not even obvious to determine in kind of a deterministic way. So you can measure really when the impulse comes to the system, or you can measure the response of the system to the impulse. And so when you look at market microstructure, you see exactly how people are internalizing the piece of news. And so you can make a informed bet on what's going to happen in the next few minutes. Predicting what happens in one day or like in even 1 week is almost impossible. I mean, it's the hit rate goes really to so close to random that you cannot discriminate. But if you trade fast, you can actually determine with decent accuracy. I mean, we're still talking about 51% versus 49. I've never seen a system that trades with a hit rate more than like 60%. Unless you go to super high frequency. But in that case, like the cost of trading becomes unbearable. So you can be 100% right, but you cannot monetize it because it's just so fast that either there is no liquidity or the crossing the spread will kill you. So because of this, it's difficult to be right more than maybe 56% of the time. And again, 56%. You can do simulation and you can see what is the Sharpe ratio that corresponds to each hit rate given the distribution of the returns, and you will see that already 56%. You're like sharp 3 or 4. So it's pretty high. But so what we do is like we provide liquidity, meaning that the fact that the way I look at arbitrage, and it's kind of like an alternative way of looking at it's kind of related to mining, right? By when somebody mines Bitcoin, they're providing a service to the market, right? You validate transaction, and because people needs to be incentivized, otherwise they wouldn't get out of bed. They get a little Bitcoin here and there. So that was like kind of a smart way of embedding the right kind of incentives in Bitcoin. And I think it's absolutely fascinating, all the tokenomics and how you can build a system where you align the interests of each person with the greater good. So a little bit kind of like like the invisible end from Adam Smith. Like how do you make sure that when everybody maximizes their own benefits, the entire system works better. And so because of incentives, like people mine, and in the same way, because of incentive, people arbitrage and make the system more liquid and take it side of the trade that otherwise nobody would take for any reason. And so arbitrage is necessary for the system to work properly. And maybe people look down at why spending all this money for building this prediction system? Why don't we just use it to cure cancer or whatever? But they don't understand that without that piece, it would be, the market would be inefficient, and that's one of the few things that economists all agree on. An inefficient market doesn't work properly, and it is the law of one price is probably one of the few real law in economics, right? So what we do is like we make forecast and provide liquidity, and so and we are compensated by the market for this function, for this for this service in the form of trading profits. So and the fact that Bitcoin is so volatile and so fragmented is just like it makes our life extremely interesting, because there are so many arbitrage opportunity. The same model in equity is like flat, and in crypto can make 20% a year. So it's just because crypto looks like equity before 2008, when there was Archipelago and all the ATS and when it was deregulated, and so people were just starting an exchange from their own computer at home. And so then obviously the government stepped in with Reg NMS, which was like a decent attempt of trying to curb the inefficiency, but I'm not really sure it was also had some side effect. And also it's kind of best effort. It doesn't guarantee that people don't get screwed. They still get screwed, but in a different way. People pay for order flow, and that's kind of like it's a way of somehow abusing the system. So, it becomes philosophical, right? What is good, what is bad? It's kind of difficult to even ex post, assess.
Yeah, no, that's really interesting. I mean, I guess when you're building these models that can be used to like arbitrage Bitcoin or provide liquidity and capitalize and earn some sort of like decent return, how do you like make sure when you're building these models that you're not just being like fooled by randomness? I guess my perspective on Bitcoin is I'm not a trader. It's interesting to me. Like it's cool that people can predict the future, but I think a lot of it probably comes down to like luck, unless you have like a really good algorithm or something. So I'm curious, like how do you know that the model was like really works and there's not just like it's just random chance that you rolled heads 5 times in a row or whatnot? How do you think about that? Hey everyone, this week I want to talk about Stampseed. This is very cool metal plate where you can literally stamp your Bitcoin seed phrase with this hammer that they sell you into this metal plate. This is a must-have for all Bitcoin holders. If you have taken self-custody of your Bitcoin, you want to make sure you've recorded your seed phrase on something that is fireproof, waterproof, and time resistant. This is a great product for Bitcoiners who have taken self-custody and want that extra level of security and resiliency to store their Bitcoin. So if you are interested in this product, definitely check out stampseed.com. Use code Blockware15 for 15% off the entire website.
There is no certainty about anything. I mean, we quantify the likelihood of being right and not be fooled by randomness. But I think we're fooled by randomness all the time. And actually, I think in my personal opinion, randomness really governs and explains most of our life, and also because the thing is that we don't have a way of doing controlled experiments where you can say, well, I can use this experiment to find the cause effect relationship. So just to make an example of people that run startups, the amount of luck is huge. I see it in my case. If we got acquired 1 month later, a success story would have become a failure. And it's just like if you perturb the system just a little bit, things go completely, the output changes completely. In fact, that there are mathematical techniques to kind of stress test a model and see, what will happen, kind of simulate what if scenarios, right? Bootstrap, jackknife, all those techniques are very efficient. The problem is that, first of all, we cannot run experiments on our universe. There is only one realization. So pick whoever is your favorite, hero, startup hero. I don't know, Elon Musk, Zuckerberg, whoever it is. Just perturb a little bit the system. Let's put Mark Zuckerberg, I don't know, in Italy, just because I'm Italian. Let's do this kind of thought experiment. Would it be so successful? I don't know. I'll let you guys think. Or just, and the problem is that I think we fool ourselves, because then, especially when people look back, they only see that specific realization of their life, and so they, on one side, I think they kind of create the story after the fact. Say, well, I did this because I knew that this stuff will happen. But for instance, if you look at the interviews of Mark Zuckerberg at the very beginning, he didn't have any clue of what the heck was going to happen. So obviously he did a good job in navigating and taking the opportunities and take advantage of the situation. But again, I think we don't understand that just change a little bit about your life. Your parents, instead of being, I don't know, whatever they are, lawyers, they are crack addict. What's going to happen to you? Then you're going to convince yourself, no, but I will find my way, just about working hard and never give up, all this bullshit. But in reality, it's not going to work. The initial condition matters so much that it's very difficult. But obviously the system needs to make you believe that, you can overcome all the difficulties. Otherwise, I don't know what will happen to us as a species. The VCs always convince you that you can do whatever you want. It's just like swing for the fences. Obviously, their incentives are different than the incentives that you have. They are maximizing for the outcome for themselves, not for you. But yeah, my take is like everything is pretty much random, and I take a little bit of solace from the fact that in finance we can quantify a little bit the likelihood that everything is random. But even good models, when you put them in production, you see that there is a degradation in performance. 50% degradation is not unheard of. So there is an optimism coming back to models. The more you fit, obviously, the more it's likely then that you're going to just pick up noise. So that's why what we do in finance is so difficult, because we cannot do control experiments. Everything is like non-stationary. Nothing is Gaussian. Everything has like long tails. So all the horrible hypotheses that make very difficult to predict the future. But at the same time, there is hope. I think probably I would say everything that predicts in 1 month, in more than 1 day, I would say it's 99% random. If it works, it's insider trading or it's just luck. There are tons of studies that look at performance of manager, like a good manager. What is the autocorrelation of good performance for a good manager? It's pretty much actually it's negative autocorrelation. When it's kind of mean reverting. If you do really well, it goes back to zero, and that is telling you that it's totally random. It's totally luck. But on one side, because people are just the financial understanding is like typically abysmal, so it's very easy to get fooled. And humans are not good at thinking probabilistically, so we need to have an explanation. This guy is good because of for whatever reason, and so we build all this story. But in reality, I would say 99% of the stuff is random. So hopefully that I'm not depressing you, Joe.
No, that was really interesting. I mean, it made a lot of sense to me. I didn't know exactly how you're going to respond to that, but I would agree. I mean, a lot of stuff I feel like is random, but I guess if you have that edge where you're right 50.1% of the time, and you can know that, and you can do that over and over and over again, then maybe you have a pretty serious edge.
Oh no, a short interval. Yeah, obviously the edge is there. Market is inefficient, and you can pick up these changes. But I can tell you that building this model is incredibly difficult. I don't think people understand the complexity, not only of building the model, but all the infrastructure that it takes to put a system in production, especially if you want to do it in a way that is engineered, sound from the engineering point of view. The model part is like 1% of the system that we built. Our entire system is more than 500,000 lines of Python code. I mean, it's massive. You need to onboard the data, do a bunch of like simulation, reconciliation, deployment. I mean, the complexity is mind-blowing, and people don't understand. They say, what is the difference of what you do versus like some random arbitrage bot that I found on the internet? Well, difference is that the bot doesn't work. It's that simple. It's a scam.
Yeah, I mean, it makes sense. Yeah, it's pretty wild to think about. I guess this is kind of another interesting question, kind of for you, like since AI is kind of a popular buzzword now. Like, how do you think? Like it's very difficult to predict things in finance and I guess in markets in general. But then people are creating like self-driving cars where like the failure rate can be very low. I guess like how do you rationalize I guess they can run experiments in the physical world and that's better.
Experiments and there is there is a basic reality. There is a physical model, right, that you're trying to approximate. Like cars don't move randomly, are not affected by your feelings. Instead, the market is affected by how you feel. That there was this interesting experiment back in the day where there was a correlation between the direction of the market and the weather in New York. Now, it might be spurious correlation. But I would actually say that in this sense it's actually possible, because there is a, if the day is sunny, you are happy and you're in a good mood. So the problem with finance is just that you need to predict not only how people will react to a piece of news, but also how they will interpret it. And then there is all the game theoretical part of how people are going to think that other people are going to react and react in a recursive way. So it is a tricky, it's incredibly tricky. In fact, I think the complexity of the model, I wouldn't say the complexity of the model. I think the models that work in finance are extremely simple, because they are based on simple economic principles, right? And that's what I think works. I don't think black box trading, you get some data, you throw it in whatever is your favorite machine learning technique, you throw this thing in and something comes out. It's going to be garbage. Deep learning doesn't work for trading. Maybe super high frequency trading, maybe reinforcement learning can give you an edge, but again, to explain things, you need to linearize, you need to make them simple, and so the models that I think are worth in finance are extremely simple. What comes in is the intuition of what is the phenomenon that you are trying to explain, and obviously the rigor of doing the research. You need to have an hypothesis that you are testing. You should be very careful about overfitting, because of the randomness that we were talking about. It's very easy to find an explanation after the fact, and so what you need to do is that you need to come up with an hypothesis, test the hypothesis, and then control for how many experiments you're doing to avoid to pick up some bias there. So from the technical point of view, I think building an high frequency trading system is much more difficult than self-driving cars. I think Andrew Lowe, professor from MIT, said, it's like predicting, it's like doing physics in the case that electrons had feelings. That's kind of the things that we have to confront.
Yeah. So I guess if you did do that deep learning or unsupervised learning on finance type stuff, it wouldn't work very well, because it would just be very overfit on old data. Horrible. That would basically be the issue.
Yeah, it would be horribly overfit, because what's happening is, this problem has been solved from the theoretical point of view with VC dimension and the branch of statistics. The model should not be, the complexity of the model should not be related to to the complexity of the underlying model that you're trying to explain, but it should be related to how many data points you have, and it's kind of scaled down depending on how much noise there is in the system. So if you have a system that is very noisy, you can only explain the model, the underlying very complex model, with an extremely simple model, and that's what happens in finance. The other extreme is self-driving cars. You have models for pretty much everything. There is a model that is not changing over time. Physics, law of physics are stable as far as we know. And the problem is just do I have enough data and a complex model enough to fit this data and explain reality? And then obviously I can also do control the experiments and all the stuff. So it is obviously incredibly complex to build self-driving cars and all, but at the same time you know that given enough data, given enough computing power, the problem is solvable. In fact, it's I don't think it's that far from being completely solved. In fact, the issue with self-driving cars is that there are humans, and if everything was a car, the problem would be solved. The issue is that how do you deal with the insanity of people texting and while driving and so on? Those are the problems, not the underlying reality.
Yeah, makes a lot of sense. If it's so interesting. So like I guess self-driving cars was in the past like has been like a data and computation problem, and because it's based more in reality, now that we have like the data and the computation, like
Mhm.
we can kind of solve that problem for the
Yeah.
most part, or we're very close to. Is it for like finance or more very complex things? If we had like enough data, like say we had like sensors in everyone's brain or some crazy like future, like would it potentially be possible if we had enough variables and enough data and enough computation to like predict things in finance, or is that like something that is impossible forever?
Well, this comes down at at kind of like is the universe deterministic or not? If you know all the pieces of information that you need, yes, I think because it's a macroscopic system and it's not kind of a quantum system. I think you can predict it perfectly. In fact, I think people can make money using insider trading, which you don't need to have information about what everybody else does. You just have to have a little bit more information than anybody else. So, yeah, I think what is going to happen, in my opinion, is just that the system, the markets are going to become just faster and faster. Obviously, anytime there is a kind of a change in regulation or like some other like major effect, like COVID and so on, the system gets reset, and then there is a big spike in inefficiency, and then people start adapting again. But so nobody will ever be able to predict the market, perfectly. Obviously, even if you can, there is a limit to how much money you can make because there's issue with liquidity. Sometimes even if you're right, you can lose your shirt because you need to be right at the right time in a certain sense. Like people that were shorting the house bubble and they had margin calls and they had to unwind the position too early. They lost money even if they were actually right. So again, everything is random, you see. So when I see like those headline, oh, the guru that has predicted whatever the previous crisis, this is what he thinks about whatever, that's obviously bullshit. I mean, the guy was just lucky. There's no doubt about it. In fact, yeah, I mean, but again, this
Yeah.
is, I think it's more a problem with humans than with reality. We just interpret and we want to find the story. Like, this guy was right and for this reason, and I want to believe that he's going to be right again. But in reality, it's just he's throwing darts and he was lucky once. Right.
Yeah. And if you were that guy, I mean, you'd probably be thinking you were right, you know?
Oh yeah, I mean, I'm sure he's convinced. He
Yeah.
drank his own Kool-Aid and saying, I made a bunch of money. There must be a reason why I did it, and the other one didn't do it. And then you start building the story, right? Well,
Yeah.
uh, the beauty of what we do is just exactly the opposite of this approach. We look at statistics. We try to measure everything. We measure risk. So anything that we do is absolutely informed. So there is the difference between like a trader and a gambler. Like a gambler is just just taking risk without really considering what is the effect. What we do is just the opposite. And the problem is that people don't understand. Even people that went to school and are smart, they don't understand what we do well enough to be able to discriminate. A hedge fund that is obviously kind of like an hedge fund that is like based on quantitative principle versus an hedge fund that is just as a bunch of people reading newspaper and coming up with the fancy explanation of what's going to happen. But even the VC industry is based on the same way. It's just a bunch of random people with MBA that maybe they didn't ever run a company that they come up with this nice fancy explanation of what's going to happen, and then maybe sometimes they're right, sometimes they're wrong, and just the randomness reigns supreme.
Yeah. Makes sense. Can you tell us a little bit more about like what you're building, like more specifically, like at Kaizen?
Yeah.
Kaizen?
What we are doing is like we are building a prop trading firm. So it's typically a firm that trades his own money, which I think is the purest form of investing. Like you don't go after fees like big hedge fund that just raise a bunch of money and then they make money just by holding others people money, making some bets here and there. What we do is that we raise money from friends and family, and then we trade them, providing liquidity. Again, I think it's a fundamental need for the market. You need people that arbitrage away the price dislocation and so on. Otherwise, the system wouldn't be working properly. And so we've been using a lot of the techniques that we develop for equities and futures, and we are repurposing them for crypto. I would say with quite good success. So numbers are looking really good. We have direct connectivity to exchanges. We build the entire pipeline, top to bottom, from capturing data multiple times a second to storing and serving those data, having a system to build machine learning. I don't think the question is the problem is not having a model, because a single model is going to be arbitrage away. It's gonna the shelf life of a model is many times 1.5 years, 2 years. Then whatever you have found out, other people are going to find the same thing, and you're going to see that the profits are disappearing. And so the question is that how can I build not like a model, but something that generates model? And so we put a lot of energy in using kind of machine learning to generate models. So building like something that builds car instead of building a car. And so we can generate new models based on some economic intuition. Again, I don't believe in just running a bunch of tests looking for correlation, because how do you know that a correlation is not going to be spurious? I mean, if you look long enough for correlation, you're going to find as many as you want, right? Again, the VC dimension applied again to the same problem. Like when the more you mine the data, the more likely it is that you're going to find something that is that is not real. And so we have all sorts of complex ways of measuring overfitting, and we came up with a lot of neat ideas of how to combat overfitting. And we trade on multiple exchanges, typically perpetual futures, which are extremely liquid. We typically don't trade coins that don't have at least a certain amount of trading volume. So we stop quite early right now on the liquidity curve. So maybe we trade the first 20, 30 most liquid coins, but there's tons of stuff money that can be also made by going down the liquidity curve. The problem is just that then becomes a little bit more gambling, because there are lots of scammy stuff, pump and dump. So again, you can still make money, but it becomes the risk profile changes. So I don't know. I sleep better when we can compute exactly what is the likelihood that things are gonna go fine, rather than take risks that are unwarranted. So, but the system is maturing. I mean, the whole crypto ecosystem. I think personally, obviously, I'm not happy about the current crypto winter, because I think it's like mistakes of few people kind of like brought down the entire trust in the system. And by the way, I don't want to say, and I'm not going to make names and so on, but you get a bunch of 20x years old people that never had a job. You give them a bunch of $1 billion, they don't even know how to balance a checkbook. I mean, what do you expect? I mean, VCs enabled this situation. Whatever happened, I think it's just absurd. But at the same time, it's like again, VCs want to invest in people where they can build this story. Like, oh, he's the guy that I don't know, whatever, takes the meeting while he's playing video games. That kind of again, I'm not gonna go there, but because of some people mistake, now the entire industry is upside down, and I think that's totally cool. But at the same time, it's good that we're flushing the pipe from all this sludge. Many people that came from Wall Street to tech because of trying to ride the wave. Now they're probably moving to artificial intelligence or whatever is the next big wave. So we cannot help ourselves as humans, right? We just keep making the same mistakes, and we've been doing it for thousands of years. It is what it is. But yeah, I guess I think the future is absolutely bright for crypto. I think I don't have any doubt that it will be completely revolutionary. I think especially once microtransaction become cheap, I think that is going to be like it's going to unlock a huge amount of potential. I think our view from US is like completely biased. Outside of US, people don't have a currency that they can trust, and so crypto is the only alternative. Obviously, the system is going to try to resist. Look at what the SEC is doing. They could be regulating and trying to put a little bit, a little bit of orders. But I think this is like the last attempt of the man here to put the genie back in the bottle. In my opinion, it's way too late. It's like trying to defeat gravity, or like saying, hey, from now on nobody can access internet. How are you gonna stop it? How are you gonna stop? Especially when there are economic incentives. That is what drives people, right? If something is better than something else, I have no doubt that in long enough time people are gonna just move to that system. That's why just even. But yeah, crypto is the future, and there is no doubt about that.
Yeah, I mean, I'm definitely very optimistic about Bitcoin. I think this was a really interesting conversation. It was interesting to hear your background and how you think about markets. That's pretty fascinating. Where can the audience go to learn more about you or what you're building?
Well, usually we're like the A team. I don't know if you remember the TV show from the 80s or 90s, whatever it was. Like if you have a problem, you know how to reach out to us. But you can send me an email at gp@crypto-kaizen.com. And by the way, never put crypto in the name of a company. I found out that banks don't like it. In fact, we're going to change the name of the company to Kaizen Finance, because crypto. The name is not cool. You gotta avoid crypto. But yeah, you can send me an email there. We also run, Paul and I run this project called sorrentum.org, where we build Web3 primitives with students and faculty at the University of Maryland. We're building some pretty cool stuff, in my opinion. You can look me up on LinkedIn. I have a pretty uncommon name, so I think it would be pretty easy to find out about me if you want to contact me. But again, I like to write code. In fact, this is probably the first time that I talk to anybody about what I do. I'm typically just under the radar doing my stuff, and
Yeah, no, this is awesome. So thanks so much for coming on. I'm sure people are going to find this very interesting.